As we approach the end of the financial year, now's a great time to talk about ways to manage tax, maximise your super, and optimise your superannuation income streams. In this video, we'll outline new and core opportunities and considerations in the lead up to 30 June and beyond. To help you navigate through the video, here's the agenda of what I'll be covering and the time of when those segments will be discussed. If you're no longer eligible to contribute to superannuation, you might like to skip forward and watch from minimum account-based pension payment rates. Firstly, let's touch on the key end of financial year considerations that are triggered by recent or prospective legislative changes. Making voluntary pre-tax or concessional contributions provides a greater tax benefit if you make them before the Stage 3 tax cuts commence on the 1st of July this year. This is because the marginal tax rates for most income brackets will be lower next financial year. This table illustrates the additional tax savings available for clients at different income levels by making pre-tax concessional contributions of $10,000, for example, in this financial year. Did you know you can make larger pre-tax concessional contributions if you haven't used all of your concessional cap in earlier years? Well, here's how it works. If you make or receive concessional contributions of less than the annual concessional contribution cap of $27,500 per annum, you may be able to accrue these unused amounts and carry them forward for use in subsequent financial years. This is known as the catch-up concessional contributions. So catch-up concessional contributions can accrue from 2018-2019 financial year. And from this case study, you're able to see the last 5 years and the amount of concessional contributions versus the cap for each financial year and the balance of the unused cap amounts that can be carried forward for up to 5 years before they expire. So therefore, in this example, the case study client is eligible to make $60,000 in catch-up concessional contributions, and this could have a significant impact on your tax position this financial year. To be eligible to make these catch-up concessional contributions, one criteria is your total super balance must be below $500,000. So what are the benefits? Catch-up concessional contributions can help you to maximise your effective super contributions, essentially to reduce your income tax or make up for when you're unable to contribute to superannuation, so if you're out of the workforce. But most commonly for our clients, it's to reduce their tax when they receive a redundancy payment or reduce tax on a capital gain on the sale of a property or an investment. Superannuation, being the backbone of retirement savings in Australia, is subject to various caps and limits. So as of the 1st of July 2024, several new superannuation caps will come into effect, presenting both challenges and strategic opportunities for clients planning their retirement savings. So the new superannuation caps from 1 July 2024 are as follows. The pre-tax concessional contributions will be increased from $27,500 to $30,000 per year. That's the contribution that gives you a tax deduction. You may want to adjust your salary sacrifice amounts to get you up to that new cap of $30,000 next financial year. The non-concessional contributions cap will be increased from $110,000 to $120,000 per year. So clients who meet the eligibility criteria may still be able to make up to 3 years worth of those non-concessional contributions in a single year, utilising a strategy which we call the bring forward provisions, which will increase the contributions to $360,000. So clients usually use this strategy in the years leading up to retirement to significantly increase the amount of money they can get into super. Thirdly, the downsizer contribution cap. Look, unfortunately, there's been no mention of this cap increasing or being indexed. So it will remain at $300,000 per person for those who meet the eligibility criteria. So essentially, if you're 55 years or older, you may be able to contribute up to $300,000 each from the proceeds of, say, a home or part sale of a home, and you can put that into superannuation. A downsizer contribution is essentially a non-concessional contribution, but it doesn't count towards the non-concessional contribution cap. You should always really consider the impact and especially the timing of your contributions to maximise the most optimal outcome. So what are spouse contributions? Spouse contributions are when you may be eligible for a tax offset of up to $540 when making super contributions of up to $3,000 into your spouse's super account. So if your spouse's income is $37,000 or less in 23-24 financial year, you're eligible for this tax offset. And what is the government co-contribution? The government co-contribution allows lower income clients to be eligible for a government co-contribution where the maximum is $500 of free money from the government if you contribute $1,000 into super and you earn less than $43,445 per annum. And there's not many things in life that are free, but this is one. Once you start a retirement income stream, minimum annual payments are calculated on your account balance on the 1st of July each year, multiplied by a percentage factor that increases as you age. This is often referred to as the minimum pension drawdown. Fortunately, our clients have their superannuation in an administration service whereby the minimum is automatically paid before the end of the financial year. And for those clients who will be celebrating milestone birthdays such as 65, 75, 80, 85, 90 or 95, your minimum drawdown will increase even more as the government wants you to draw down on this tax-free asset and income stream at those milestone birthdays. The table shows the temporary rates versus the normal rates. So for example, someone aged 65 to 74 must have withdrawn 2.5% of their account balance in the 22-23 financial year under the temporary measure, but this amount doubles to 5% this financial year. The percentage factor is set according to your age on the 1st of July in the financial year that the pension is to be paid. The amount of age pension you receive is determined by the income test and the asset test. So if you're on the age pension or you're heading down the pathway of being eligible, it's good to know the income test is not affected by the amount you withdraw from your superannuation pension, as Centrelink applies the deeming rules to estimate your superannuation pension income. So we'll talk about deeming in a minute. However, the asset test does include your total superannuation balance and any assets outside superannuation. So this presents an opportunity for retirees whose assets are slightly above the age pension threshold, as the more you withdraw from your super, generally, the more age pension you may be entitled to receive. Now, we've really been quite excited about this advice, and at Highland Financial Planning, we specialise and lead the industry in age pension eligibility, and we have strategies and access to products to reduce your assets test and increase your age pension payments. In its May 2024 budget, the federal government announced another 12-month extension on the freeze on deeming rates until 30 June 2025, which is fantastic news. Well, that's a wrap on our end of financial year update. If you've made it this far, thank you. Your circumstances might change and you may like to discuss any of the aforementioned strategies. Please feel free to reach out, and I look forward to talking to you soon.